Hey there, traders. Todd here, Trading Analysis. Sorry, I've been away. No excuse. I've just been so heads down in markets for our clients at InsideEdge Capital in the wealth management business and the research business, Trading Analysis. I've been doing all markets and no marketing. My bad. I'm sorry. So let's jump back in. I'm it's time to go. It's time to talk to everyone, and markets have been awesome. An amazing move after the election. We're heading into the Fed here in about 50 minutes. I wanted to get hopefully a quick video out to you, but we'll see what happens with the balance of the House of Representatives. But it looks like a red wave is here, which should usher in an area of deregulation, pro-growth, and we're seeing the markets, both small caps and large cap growth, power ahead. So it's looking pretty good. One thing I want to talk about is the fear of whether a Trump presidency is inflationary, the impact on rates, what's happening, specifically the dollar, and some like the way interest rates and the dollar are working. I think a lot of market observers and traders and investors are getting it wrong, and they don't quite understand this. So hopefully I can shed some light on it for you. So let's go. What am I doing? Right there. Okay, so we're heading into Fed rate cut, and there's like 96% chance that we're going to get a 25 basis point cut today, 3.5% chance of nothing. And then the glide path is after today, 1, 2, 3 cuts into 618. There you go. FIBO of 2025. So whether we get that or not, we shall see. I got to see what the commentary from the Fed is, okay, after this meeting. So we're looking for 25 today and 25 again in December, on hold in January. That's fine. Well, what's interesting is when they cut rates the first time, the first 50 basis point cut was right here. And you can see that the 10-year yield has rallied very sharply from 3.6 up to 4. We just came into 4.47 resistance, which is what we're going to talk about. So it's interesting. As soon as the Fed cut rates, long-term rates spiked. Now, what the reason for that? Multiple reasons. Whether the view that either a Harris administration or Trump administration be inflationary because they both like to spend like drunken sailors, or is it related to credit quality issue from the U.S., or is it just a rotation into equities out of fixed income? Because maybe we're not going to get as many rate cuts as the markets are expecting. There's a variety of different reasons, right? But the point is that the U.S. 10-year yield, it held support that we identified ahead of time. Now there is a confluence of trend lines here from going all the way back from May of 23, touch point here in February 24. Now we're holding resistance. Okay, so broken support becomes resistance. And then on the top side of the 10-year yield, you've got two touch point trend line that's intersecting on top of a 786 retracement of the 10-year yield. So we were looking for resistance at 4.48, 4.47, and that's what's happening so far. But on the approach to that, what was happening is the dollar was rallying, okay? And traditionally, dollar rallying is not going to be good for equity markets because so many of our large cap growth, multinational exposure, if you're dollar strong, when you bring home those earnings, you're going to bring home less dollars to go into the corporate bank accounts. Now, I know Trump has his eye on a lot of overseas earnings from our American companies, and he's going to try to find a way to be able to repatriate that at a lower tax rate. So, there should be a continued dollar bid with the repatriation that way. Now, traditionally, as I mentioned, the dollar strength is going to be counter to the direction of the stock market. Well, it's not the whole story, and here's kind of the point of the video today. So the dollar has rallied, and I love that 786 retracement. Okay, so you take the June of 24 down to September 29. A lot of times when a market runs through a 618 retracement, it'll go up to the square root of 0.618. Take your calculator, do the square root of 0.618. It's 786. For some crazy reason, it works. And we've rallied, but tried to get above 786, but we snapped back below. The reason the dollar is rallying, and again, there's a lot of market commentators out there saying, oh, rates up, dollar up, bad for stocks. Not the whole story. what's going on is the yen carry trade is going back on, and that is a bullish global macro indicator. So if you look at dollar against the yen, right, the dollar, it trades against all the other international currencies, so FX is a relative game. The higher one country's yields go relative to another country, that's what creates that foreign flows, the capital flows across the border. Well, dollar yen has gone from the September 16th, whatever, that first 50 basis point cut, dollar yen has rallied quite sharply. Dollar rallying against the yen. Also, you can look at euro US dollar, and being that the dollar is in the first position and dollar yen in the second position of the euro USD quote, a euro USD chart dropping like this is showing euro weakness, dollar strength. So we know there's dollar strength against the euro. We know there's dollar strength against the yen, right? So what you do is you're like, where is the dollar strength focused? You take the dollar out, you look at the cross rate. This is a little trick that you can also apply to crypto if you want to use this trick, like you want to see who's stronger, Bitcoin or Ethereum. You take the dollar out, you look at the euro yen cross rate. Since that September move, euro yen's up. Kiwi, New Zealand dollar against the yen's up. And look at the breakout we just saw in the Aussie against the yen. This, here we go, I'll just keep going to be a little emphatic on my point. CAD yen up. Euro yen, Aussie yen, dollar yen. I showed you Kiwi yen. Any of the yen crosses, right, are going up, and that is basically the carry trade going back on. The carry trade is real simply borrowing yen at a cheap price in Japan, investing overseas in other higher yielding asset classes to get that interest rate arbitrage. Big global macro funds and sovereign wealth and these guys wouldn't be doing that if the outlook for volatility was going to be high and global equities aren't going to continue to rally, right? And we saw a pretty spectacular drop in the VIX after this election. So if we just pop up the VIX right here, we just had an implosion in volatility. And that's what those global macro guys want. So the whole story with US 10-year yields and 30-year yields, the rallying of the dollar, it's a nuanced conversation that you got to understand. Listen, I used to trade for an FX hedge fund during the global financial crisis, so I live this stuff. And when the summer, August volatility swoon happened and media's reporting it's another yen carry on one like 2008, dude, not even the same ballpark. And I think we've talked about it on this channel before. But the yen carry trade is going back on, okay? Now, you got to look at rates. It's not just the 10-year yield. It's just not the notional 10-year yield. You got to look at real yields. And this is going to be a conversation another time, but we're still going to be persistently looking at 2.5% inflation. Rick Reeder from BlackRock on CNBC, I think it was yesterday, he's a really smart guy. He's like, we're going to continue rolling 2.5% inflation. We'll see what happens. So you have to look at the nominal yield, then factor in inflation to get you the real yield, and that matters. Right. And the other thing you got to do is you got to look at the short end of the curve too. So 2-year yields are also going up, but not as, I guess I can leave that percent change. Yeah, that's actually fine. So the 10-year in blue is going up faster than the 2-year yield. All right, let me take this off percent change and just go line. There we go. Okay, so 10-year yield is going up faster than the 2-year yield as we're going into this cut. What does that do? That takes the 10-2 yield curve, the so-called yield curve, and right now this is not accurate because I get delayed quotes on this charting platform. I think we're at about 15 to 17 points of a normally shaped yield curve, which is shorter yields are lower than longer yields. So again, if that 10-year yield is going up faster than the 2-year yield, that's going to take the curve further away from inversion. And just a real simple way, if you don't have U.S. yield quotes, you just go to CNBC, just go to markets. Where is it? Bonds down here, right? So your 2-year yield is 4.21. Your U.S. 10-year, where the hell is it? Right here, is at 4.39. So we have 12 basis points by which the 10-year is higher than the 2-year, right? 12 basis points. So, when my quotes open up, it'll be back up here. And if we continue to go in this direction, that is the yield curve moving further out of inversion, which is right here. Of course, the big question as we head into a potential Republican-controlled Senate, House, and Oval Office is this, right? It's the budget deficit as a percent of GDP, right? When Trump came in the first time in 16, it was like a minus 3.5% budget deficit to GDP. Well, now he's rolling in double that. So we got to be a little bit more cognizant of spending. So that's deficit to GDP, and here's total U.S. debt as a percent of GDP running at 119%. So that's going to be the concern here, is, you know, with Elon Musk in his ear, and I feel like Elon might be one of the few guys that Trump listens to, and he's got a pretty sharp cabinet. You know, is austerity, is reduced spending going to be a factor, and will that impact growth? We have to watch and see how that happens, and rates are going to be super, super important to the direction of the stock market. But from where I sit, things look really, really good right now. Bitcoin's breaking out. Gold's breaking out, Bitcoin specifically, and Bitcoin and gold are both counter to that US 10-year yield, right? I mean, if you overlay them, we can do it in another video, you can see how close it is. So that's everything that's going on from the macro point of view. Hope that helps, guys, and I will see you on the next video update. I need to do these more regularly. Check us out at tradinganalysis.com or InsideEdgeCapital.com. See you guys. Take care. Hi, it's Todd from tradinganalysis.com. Thanks so much for watching. Listen, my team and I have so much to share with you in terms of our technical analysis, our fundamental analysis, portfolio management tactics, trading in and out, maybe options, sector rotation. Let us know what's most interesting to you. Maybe drop that in the comments section and we'll do our best to work it in. Also, consider clicking the subscribe button and the bell icon to be notified when we put out new videos. And finally, you can check us out at tradinganalysis.com if you'd like to see us manage our real portfolios in real time. Thanks again for watching.